Hello and welcome back to Express videos relating to ACCA Paper P2. Remember to download our Express notes, which you can find them on our website at www.dxpgroup.com. In this current video, we will cover IFRS12, which deals with share-based payment, which is a common feature for senior staff in listed company. Whenever senior staff in listed company are entitled to buy cheaper shares, they stand to make a gain by selling the shares at a full market price. And on the other hand, all the other shareholders in the company will actually have a loss because the share price actually fell. In order to reflect this, prior to IFRS 2, the companies will record this as debit cash, which is the actual cash received from the senior staff for the cheaper shares, and credit the share capital and sometimes the share premium account if they were sold above the nominal value. IFRS 2 will actually tend to remedy this discrepancy as long as the senior staff have to work over a certain period in exchange for cheaper shares. This will actually be reflected into the account as an expense over the vesting period. Since IFRS 2 actually has come into place and forces company to record a staff cost for the respected number of shares that must be issued at each year end, IFRS 2 became very, very unpopular. So the suggested approach in the exam is the following. First of all, the important thing is to decide whether or not the payment will actually be based in shares or it will be based in cash. Or in other words, are we dealing with equity settled transaction or a cash settled transaction? The distinction is important because it will actually tell us which value to use when we actually estimate our year-end liability. For equity settled transaction, the option value will be frozen at the grant date and it will stay fixed over the vesting period. So frozen at grant date. For cash vest payments, the option value will change at this year end to actually reflect the latest value. Then we work out the vesting period. And this is the period over which the staff might stay under the employment contract with the company in order to be entitled to buy the cheaper shares. And this is actually going to be spread, the total cost, over the vesting period. So if it's a 3-year period, in year 1 we'll book 1/3 of the expense, in year 2 2/3, and the final bit in year 3. To work out the cost for each period, we will basically do at each year end our latest estimate based on the number of people who will actually continue to work for the company and the number of shares to which they are entitled. And we divide this all between the years at grant and vesting period and deduct any costs which were already accumulated in the previous years, and the difference must be the current year charge. So expected total cost over total cost to date. It's another way of putting. Let's have a quick look at a numbers example where we have Crossman Corporation on 1st of January X1, which granted 5,000 options on shares to each of its 200 most senior staff. Each option is conditional upon each member of staff actually staying in the company's employment until the end of December 2000 X3, so 3 years. And at that time, participating staff can continue to hold the share options and may choose to exercise them either on 31st of December X4 or X5. Each option allows the holder to buy Crossman Company shares at a price of $1 each. And we are given the data at each year end for the fair value of the option, number of participants expecting to stay until 31st of December X3, and the share price. this is going to be an equity settled transaction. So I have the right to actually buy shares for $1. Therefore, on 31st of X4 and X5, and therefore the value of each option will be frozen at the grant date. The rest is not relevant to us. What it will change is the number of staff which eventually will stay with the company to have the right to buy the cheaper shares. Total expected cost of the company when we grant them, for instance, is going to be the number of options multiplied with the number of staff that we actually expect on the 1st of January when we granted these options, multiplied with the fair value of the option at that date, which is 2.97 million. Then decide what's the vesting period, and the vesting period is of 3 years until 31st of December X3. And then the cumulative cost for each year must be worked out. Okay, so at the end of X1, X2, X3, because afterwards the cumulative expenses will pretty much stay the same, we'll have to work out based on the number of shares, options, which is 5,000, the option value at the grant date, which it will never change during our estimation, and the estimate at each year end of the number of people that will actually stay employed in the company in order to have a right to buy cheaper shares. And the expense in the current year, it's like any other provision, but this time we'll actually show it as an equity reserve because it will be featured, it will be settled in equity. So in year 1 we debit expense and we credit an equity reserve for 962,500. In year 2, actually we will do it on the difference between the year-end estimation of a total cost and what was already booked. This minus this is the current year expense. Contrast that with the second example where on 1st of January X1, Right Company actually grants 15,000 cash appreciation share rights to 150 of its staff. So this one is going to be, once you read this, settled in cash. These rights will give a bonus in cash based on the price of the company, and the cash appreciation rights offer a cash payment equal to the company share price at the exercise date less the share price at the grant date. Participants will have to stay in the company until the end of December X3, so again 3 years, in order for the rights to vest, though they may exercise the rights at the end of X3, X4 or X5. And we are given the data when we actually started the scheme and until the end of X5, the number of options exercised in the period and the number of participants expected to stay until the end, and the share price. In here, after we basically decided already that this is a cash settlement transaction, the number of vesting period, the number of years is 3 years, and the cumulative cost is going to be worked out, including updates of the cost in the share price. Okay, 145, 150, 152, and the cash that they are entitled to is basically by reference to 1.2, which was the share price at the grant date. Any increase is going to be paid as a bonus to the staff, and this is exactly how it's calculated. 15,000 times the estimation of the staff that will stay with the company until the end of the scheme, multiplied with the difference between the share price at the year end and share price and the grant date. Okay, year 1, year 2 and year 3 of a scheme is the adjustment. Okay, and in here we will book it debit expense, credit liability, because it will be settled in cash. And if you want to use T accounts or reflect this in T accounts, you'll start with an opening balance, charge the expense for the period, 3 cumulative years, and then, you know, based on the information which is given to us, the shares will start to be actually exercised, the options. One thing that I want to point out is deferred tax in relation to these share options payments. So depending on the jurisdiction in the world, some tax authorities will grant basically nothing in respect of the expense created for share-based payments. Some of them will give a right to actually deduct part of it. In the exam at P2, in virtually all the questions which in which he actually mixed deferred tax with share-based payment, he said that future tax is actually going to be deducted on the intrinsic value of the share-based payment. And what I want you to remember for exam purposes is that this intrinsic value is actually the difference between the spot price of the share and the exercise price of that particular share. So coming back to the first example where we have the number of participants, shares price and intrinsic value. Remember, the intrinsic value is going to be calculated as a difference between the share price less the price which is going to be paid by the employees, which is $1. Okay, and that will be the intrinsic value based on which basically we can calculate a deferred tax asset. How? We will look at the number of options which are expected to vest at the end of each year. We will take the intrinsic value of the option we just calculated, 3.25 and 2.20, and we calculate the expected future tax saving. And we will book a deferred tax asset, multiply with the tax rate at the end of the period.